Hey everyone, happy Thursday, February 20th. It's about 9:45 in the morning on the West Coast, and it's time for another market update. This week we got retail sales data, which is important. Take a look at how the consumer's spending. We got some new housing data, and we got the release of the Fed minutes from their last meeting, which is always important to take a look at. So let's get right into it. Like I said, going back to last Friday, we got January's retail sales. Those came in down quite a bit, down negative 0.09%, almost a full percent. The estimate was they were supposed to come in flat. The core number was down, again, almost a full percent at negative 0.8%. But they did make some positive revisions to December that, softened the gains we got out of this a little bit. And then keep in mind, January was a cold month. There was a lot of, winter storms, things like that, fires, in different parts of the country in Southern California. So that has a damper on the economy when people aren't going to go out as much and buy things if it's too cold out or they're dealing with natural disasters in their area. So good to see that coming lower. The bond market did like this, so mortgage rates did improve because of this, but it wasn't as great as it initially seemed, and probably be a bounce back in February because Americans like to spend money. Next thing we got January starts and permits. So these were also down, and again, a lot of it had to do with the temperatures. Cold weather across the country. People they're not going to start as many homes. So permits is the first chance we get at really what the new housing is going to look like. First thing people are going to do is pull permits. Those were up slightly month over month, still down almost 2% year over year. Like I said, starts were down quite a bit, down almost 10%, and again down almost a full percent, down negative 0.7% year over year. Construction, so ones that have actually started construction, makes sense, is down a month over month, year over year, down quite a bit, 15.6%. And then completions are up. That's just the homes that started the process are now being completed as we're coming out of the winter in certain parts of the country. Like we talked about before, this is very important because, especially these permits and starts, this gives us an idea of future inventory. We know that future demand is, household formation, which is demand on the consumer side, is outpacing these numbers. So we're still operating in a deficit. That means the housing shortage probably should continue to get a little bit worse for us. Unless something happens that, all of a sudden we get a bunch of new housing, but it's hard to snap your fingers and then just create new houses. So it's a process that takes a while, and with rates being higher, with different weather things, that's slowed things down. So this is good for current homeowners, is good for appreciation, not good for people that want more housing out there, maybe to make prices drop. So next thing we got was initial jobless claim. So first chance, basically when this is when people first apply for unemployment. They've been pretty low across the board for months, almost years now. The estimate was about 214,000 new claims. It came in at 219,000. Continuing claims still are at an elevated pace, but overall, this is something the Fed can look at and say, hey, not too many people are filing for unemployment, so the economy is doing great. We're not breaking things by having rates as high as they've been for as long as they've been. Next thing, so miscellaneous stuff. So this is really the main one this week was we got the Fed minutes. This is basically the minutes from their last meeting, and it showed that they did talk about they have some concerns about tariffs, how that could create inflation. Like we've talked about historically, tariffs tend to create inflation. We don't want inflation right now. The Fed wants to keep inflation down. So if that happened, there's less of a chance of us getting rates down. And the other thing that came out of this, though, that was actually a little positive, is they did talk about pausing their balance sheet runoff. So this is something basically they've been selling off treasury bonds. If they did pause that, that would be overall a good thing for the bond market, which is good for mortgage rates. So that was something we got a little bit of a positive bump yesterday out of. Which was good to see, but overall, they're really, they're not looking at cutting rates anytime soon, and they're concerned inflation could get kicked back up if we get tariffs. Like I said, tariffs tend to be historically inflationary, but we're not, we're living in weird times. So we'll have to see how this goes. Next couple months are going to be, up in the air, really as new, presidential policies take effect, and see how that affects the economy, labor, inflation, and all that kind of stuff. So where does that leave us? The average 30-year jumped underneath 7. That's nice. Today it's down to 6.96, which I think is actually the lowest since middle of December, which is kind of sad. It was 7.04 last week, so almost a tenth of a point drop. Still higher than we wanted to see, but it'll be nice to get underneath this 7 number and stay there. Get closer to 6.5, and then make progress towards that 6 number. So good to see there some positive movement. Important dates upcoming. So next Friday, we get a PCE, which is the Fed's favorite form of inflation. That's going to be a very, very, very important one to keep an eye on. Can definitely be a market mover if that comes in either higher or lower than expected. And then we get the next Fed meeting is March 19th. So about a month away. Right now, the markets have it at 98% chance they do not do anything, a 2% chance they cut. I think the markets right now only have one more cut priced in this year. So overall, basically the data is going to have to turn in our favor. We're going to have to see job market weaken. We're going to have to see inflation continue to come down if we want the Fed to cut rates again. So that's what the important data we're going to be looking at is those jobs reports and inflation reports upcoming. Good to see, though, like I said, some positive movement down. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.